Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Erik Oliver. Erik is the Regional Manager for Cost Segregation Authority. And in just a minute, we're going to speak with Erik about cost segregation, what it is, how it works, and the benefits for real estate investors. But first, a couple of reminders. If you like our show, CRE PN Radio, there are a couple of things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Erik. Welcome to CRE PN Radio.
Oh, thank you, Dan. I'm glad to be here.
I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little about your background.
Sure. So my degree is actually in accounting. Math always kind of came easy to me in school as opposed to English or science for that matter. So I was in college and said, how am I going to get this done quickly? And so I decided to go into accounting, not really knowing what I wanted to do at the time. And so my background is in accounting, and then my careers have taken me through business development and those type of things. And so came across this company. I had moved from Salt Lake City out to the East Coast to Virginia and then to Long Island, New York, and was looking to head back home to Salt Lake, and came across this job about 6 years ago. Kind of fit what my background was. You know, it's kind of a niche accounting firm that we worked for here at Cost Segregation Authority. And so I've really loved it. I've really been able to learn more about real estate and, work with investors and CPAs across the country on saving tax dollars. So it's been great.
Awesome. Well, to start the conversation, I mean, cost segregation, I think it's a term that many are familiar with the term, but I don't know that everybody understands what it is or how it works. And for the uninitiated, could you give a brief, what is cost segregation answer?
Sure. So, cost segregation really is just accelerated depreciation. And so, one of the big benefits of owning real estate is being able to take a depreciation expense against your income. And so what that is typically if you were to buy a commercial property, you get to depreciate that property over 39 years. So let's just, to make the math easy, let's say you bought a $390,000 office building. You would get a $10,000 write-off every year for 39 years against your income. So if you make $100,000 a year, instead of being taxed on $100,000, you've got this $10,000 write-off that now you're only taxed on $90,000, which is great. It's a non-cash expense that is a huge benefit for real estate investors to offset income. And cost segregation says, or the idea of cost segregation is, well, instead of depreciating that office building over 39 years, is there a way for us to depreciate that faster so we can get more deductions sooner? I may not own that office building for 39 years. And so how do I get those deductions quicker? And the way you do that is through a cost segregation study. And really all we're doing is just what the name implies. We're segregating the cost of that building into different buckets, for lack of a better word. And so we are, when you buy an office building, you're not just buying the land and the walls, but you're also buying a parking lot. You're buying some flooring, some window covering, some cabinets, some countertops. There's all these different components that make up that building. And the IRS says you can depreciate those over a much faster schedule. For example, carpet can be depreciated over 5 years, not 39 years. Carpet doesn't last 39 years. So that's what we're doing. We're segregating, we're putting values to that purchase price and breaking up that $390,000 purchase price in that example into those different buckets. And that allows you to take those deductions much sooner.
Got it. And when you do that, does it change and what I'm trying to say, like when I think of like a building and you talk about the 39-year depreciation allocation, or a straight line, schedule,
Yeah.
as opposed to an accelerated depreciation schedule. Are you taking that from a quote structure to like then making it personal property, or is there a like a conversion there, or is it just a matter of now that you've done the study, you can accelerate this?
No,
Mhm.
you're exactly right. We're taking that purchase, and I'll go back to that example, that $390,000 purchase. We're going to say of that 390,000, 20,000 of that was for carpet. 50,000 of that was for a parking lot. 60,000 of that was for trees, bushes, and shrubs, and irrigation, and fencing, and all these different components. And so, yeah, we're taking what we call in the industry 1250 property, or real property, and we're allocating portions of that property to personal property, things that can easily be removed without damaging the building. There's a certain criteria of tests that have to be met in order to qualify for personal property, but we're identifying that personal property and putting a cost to it. It's, if you think about it, Darren, when you build a new building, that's easy to do, right? You have an invoice for the flooring. You have an invoice for the parking lot. You get an invoice from the guys who laid the asphalt that say, you spent $80,000 on asphalt. And so you get to give that to your CPA. They can depreciate that asphalt over 15 years because that's the depreciable life that the IRS has established for asphalt. So on new construction, it's a little easier, but when you think about existing buildings, they don't give you an allocation. When you get your settlement statement and you go buy $1 million office building, they don't break it out line by line and say you bought X amount of parking lot, X amount of flooring, X amount of window coverings, right? They just say you bought a building, one big lump sum building for $1 million. So that's really where a cost segregation company comes in and puts values to those different components that allows you, again, the IRS has established these. There's a book that's 1,000 pages big that tells you the useful life of just about everything. So the IRS, there was a court case somewhere at some point, and someone argued that carpet should not be depreciated over 39 years. It should be depreciated over 5. They won that court case. And so now carpet has a 5-year asset versus a 39-year asset. And so again, you just don't know the value of those when you make that purchase. And so that's what a cost segregation company comes in and does.
Got it. And I think one of the things that is worth repeating, you mentioned, if you build a new building, you're starting at point zero. I mean, that's the 0 point, or the beginning.
Right.
Whereas if you're buying an existing property and some of those items are near their end, how does that factor in? If you've got you buy a building and the carpet's got maybe a year in it, and then you're going to have to replace it. Can you walk through how that, as opposed to the 5 years that the IRS allows for depreciation on the carpet, you've got maybe 1 year left before you have to replace it. What happens then?
Sure. So when you do a cost seg study, we're going to put a value to that carpet, and you still get to depreciate that carpet over 5 years. But let's say that the previous owner had it for 4 years, like you had mentioned. When you buy it, you still get to depreciate it over 5 years, which is way better than the 39 years by doing the cost seg study. But you're probably going to get rid of that carpet after year 1. You may even go in and get rid of it right when you move in because it's dirty, it's old, and you want fresh new carpet when you move in. So there's something called a partial asset disposition that allows you to take the remaining book value of that carpet, and you actually, when you dispose of that asset or you replace that asset, you get to write off the remaining balance of that asset. So even though the roof is, a 20, in that example, a roof is a 39-year asset, even though the roof has been on there for 20 years and it's not going to last another 39 years when you bought the building, we still put it in that 39-year category. You get to take 1/39th of it. But when you replace it, you get to take the remaining book value and write it off as an expense because you're disposing of that asset. And so if you think about it, Darren, what we oftentimes see, picture this, is that you buy a building for $1 million. And on your depreciation schedule, it says that building went into service January 1st of 2022 for $1 million. You start taking your depreciation. 5 years later, you replace the roof for $100,000. Give your CPA your invoice. They're going to put on your depreciation schedule right underneath where it says building. They're going to put new roof and they're going to start depreciating that roof over the useful life of a roof. Well, what happened to the old roof? It's still stuck in this building that's on your depreciation schedule, right? So you're really depreciating two roofs now because you never pulled it out of this building because you never had a cost seg study done initially. So you're depreciating two roofs at the same time, where one of them, you can actually write it off as an expense and only depreciate the new roof. And so that's oftentimes we correct a lot of depreciation schedules when we see that, because we're like, hey, you're double depreciating all these assets that shouldn't be. You should be able to expense them. So that's just what we call a partial asset disposition, but just wanted to note that.
No, I think to me that's one of the real magic things, because as an investor myself, before and I have done a cost segregation study, and I'm a fan. Before that, it was basically expensing things, and like you said, if you replace something and you expensed the replacement, but you still had the original that was depreciating, you didn't get to capture that. Like I said, if it's 19 years or whatever, that big chunk of depreciation that was available, just to write that off and then essentially recapitalize. Because if you take off a roof that has on your schedule, you've got 35 years left,
Right.
but you've replaced it, you're taking off that value, you're expensing that, but then you're recapitalizing it with a new roof.
Right.
And so it nets out. I mean, to me, it makes a lot more sense the way it works, as opposed to just the expense and depreciating an old roof,
Right.
kind of thing. So,
No,
and it just occurred to me because like I'm assuming when you do a cost seg study, the allocation of the value is based on acquisition costs, right?
It is, yeah. So you could do one cost seg study every time a property changes hands, because let's say you bought it for $1 million, we're going to put values to all the different components, but then in 5 years, when you sell it to me for $2 million, all those different components now have new values, right?
Right.
And so every time a building changes hands, you have the potential of doing a new cost seg study on that building.
No, and that to me would be, extremely valuable, because, well, just to reset the values.
Right.
So you're getting the proper amounts accounted for there.
Exactly.
So another thing that came to mind, and I think it's fairly obvious, but it did present a question to me. So the accelerated depreciation, you're not getting more depreciation, you're just getting to use the depreciation sooner, correct?
That's exactly right. Yep. At the end of the day, we'll go back to that office building that you paid $1 million for. At the end of the day, you're still going to get $1 million of depreciation, whether you take it 1/39th every year for 39 years, or you front load a portion of that and take a bigger chunk up front. It just means you get less on the back years. And again, there's a number of reasons why you would do that. You want to get your deductions up front, especially in today's environment where inflation is what it is. A dollar today is worth way more than a dollar 39 years from now in terms of buying power and everything else. Then you've got time value of money elements. And so instead of letting the IRS hold on to those deductions, give me my deductions now. Let me use that to free up cash flow, right? Instead of me paying the government taxes, I have this big deduction that frees up cash flow for me that I can either pay down debt, I can go invest it in new properties. There's a number of things I can do with that money to put it to work versus letting the IRS just hold on to those deductions. So, and I'm kind of oversimplifying things here, Dan. I should probably point out that land is not depreciable. Let me just make that clear. So when I say purchase price, it's the purchase price of the building. So when you buy a building, you're buying land and a structure. You never get to depreciate the land. And so you always have to back that number out of your purchase price to get what we call your depreciable basis, at which point you start depreciating on that number there.
Right. Do you have any kind of a ballpark number as far as the cash flow improvement with somebody that's done a cost seg study?
Sure. So, and I'll kind of take a step back. There's something called bonus depreciation we should probably touch on.
Sure.
It's been a huge benefit to our industry, to investors. Back in 2017, at the end of 2017, Congress passed the Tax Cuts and Jobs Act. And that was kind of the tax overhaul that was initiated by Trump. And as I'm sure many of your investors know, or many of your listeners know, Trump owns a few pieces of real estate, and the tax law was very favorable to real estate investors. And something came along called bonus depreciation. Now, bonus depreciation had been around. It's kind of something the government uses to stimulate the economy. And so every year they'll look at the economy and say, okay, how are things going? Oh, you know what? We need to stimulate the economy a little bit. So we're going to bump up the bonus percentage to, 50% bonus. And all that means is, and I'll again kind of simplify this, but if you were to buy a bulldozer, and let's say a bulldozer has a 15-year asset life, you would be able to depreciate 50% of that. If bonus was 50%, you would be able to depreciate 50% of that bulldozer in the first year. The remaining 50% gets depreciated over the next 14 years. So they're giving you an incentive to go out and buy new equipment, to build new buildings. There's a number of reasons, creates jobs, all this, it just stimulates the economy. And so back in 2017, with the Tax Cuts and Jobs Act, they increased bonus depreciation to 100%, which is huge. It's a massive benefit for real estate investors. The other thing they did is they removed just some small language in the tax law, but basically it says it no longer has to be new. You can go buy a used bulldozer and still apply this bonus depreciation. So one of the provisions under bonus is the useful life has to be less than 20 years. So if you think about real estate, it doesn't really fit into real estate because real estate is a 39-year asset, or for your residential properties, it's 27 and a half. But Darren, what if you do a cost seg study? And we come in and we identify, well, part of that 39-year building is a bunch of 5-year assets, things like carpets, countertops, cabinets, etc. Part of that 39-year building is a bunch of 15-year assets, things like parking lots, curbs, gutters, asphalt. So if you do a cost seg study, this was great. This was like the best tax law for our industry, because now, Darren, when you buy a building, you have to call me if you want to take bonus depreciation, because you don't have any 5, 7, or 15-year assets. You just have one big 39-year asset, right? So you call me, we do a cost seg study. Now you've got a bunch of 5, 7, and 15-year assets identified that are eligible for bonus. And you get to take 100% of those deductions in the first year. And so going back to your question, is there a kind of some quick math that we can calculate this? Currently, the 100% bonus tax law goes from any properties purchased from September 27th of 2017 till December 31st of 2022. So this year, the end of this year is the end of 100% bonus. And if you're eligible for that 100% bonus and you buy a property within that time frame, essentially you're going to get about 30% of your purchase price minus the land. So you take your purchase price minus land, that gives you your depreciable basis, and you can take about 30% of that depreciable basis in the first year.
Wow.
So yeah, it's a huge advantage right now for real estate investors.
So, and let me ask you something, the depreciation, because one of the caveats is you have to be a real estate professional to take the full amount. If this is in this way I understand it, correct me if I'm wrong, versus if you are, if you're a full-time insurance broker like myself that invest. I had an accountant before that was like, well, you can't really take it because you're a W-2 guy. But I've since learned that no, au contraire, as the real estate income grows, the cost segregation study was even more valuable, because then I could offset that income, and I didn't lose the depreciation. It was still available for me, in whatever years in the future.
Right.
No,
you're on the right track. So let's just use you as an example where you've got, let's say, W-2 income, and you also have investment income. Your W-2 income is treated as active income. That's your active day-to-day job, is that W-2 income. Your passive income is your investment income. You just invest on the side. And so you've got active income versus passive income. When we do a cost segregation study on your real estate, which is in that passive bucket, the deductions that we create through the cost seg study are going to be treated as passive deductions. So they can only be used to offset your rental income, not your W-2 income. And so, let's say let's say you've got 200,000 of W-2 income and only 30,000 of rental income. If we do a cost seg study and we create a $300,000 deduction, that $300,000 deduction can only go to offset that 30,000 of rental income, not your 200,000 of W-2 income.
Right.
Unless, like you said, you become a real estate professional, which there's a set of rules and regulations around that. But basically, essentially, you have to spend 750 hours a year doing real estate, and 51% of your working time doing real estate. And then you become a real estate professional for tax purposes. And what that means is, hey, I really do real estate for a living. So now all of my real estate activities become active. And so now I can use these deductions to offset any income. So they're like someone like you, I don't know your marital status, if you're married or not. Yes, you are. I see.
Yep, I'm married.
Perfect. Yeah. So a lot of professionals, and I'll use a doctor as an example, but a lot of professionals who have high W-2 income, they may have a spouse who's able to stay at home, and that spouse becomes the real estate professional and manages their real estate portfolio. And because the spouse is the real estate professional and they file a joint tax return, now those deductions can be used to offset the doctor income. And so we see that quite often. And so that's a great way to get around paying taxes on your W-2 income is, can you yourself become a real estate professional? Which, if you have a full-time job, the answer is probably no.
Right.
But if not, do you have a spouse who maybe could qualify and file that joint tax return? So that's a great point. And, you've got this passive versus active, and you want to make sure that you've got enough passive income to justify creating those passive losses. Otherwise, you don't ever lose them. Like you mentioned, they just carry forward and you use them in future years.
Right. Now, I had the good fortune to have some properties where the cash flow had increased significantly, and it really, it helped to offset the income dramatically. So that was a win.
Oh, nice.
So let me ask you, as far as we've talked about all the benefits of basically some paper losses that offset the income to reduce the taxable income. Sure. Is there any downside to this whole thing? To me, it sounds like it's just like, candy and recess and vacation, and, there's, and I'm just going like, usually there's something somewhere that's like, okay, well, there is this.
Sure. So I'll give you some of the objections we get quite often, and I'll kind of talk about two of them most importantly. One is, well, if I show this loss, then how am I going to go out and get a loan for my next property, right? Because I'm showing no income because I have this massive paper loss that just offset all my income. So now I'm basically showing that I only make $10,000 a year. How am I going to go out and get a loan for my next project? And the nice thing is that's not actually true. So depreciation always gets added back into your income for lending purposes. So for tax purposes, obviously you want your income to be low. For lending purposes, you want it to be high. Because this is just a paper loss, they're always going to add depreciation back into your income for lending purposes. So that's great. That's the first thing. The second thing is there is something called recapture tax, a question we get quite often. So when you sell your asset, so let's say I buy a building for $1 million and I sell it 5 years later for $2 million. When I sell that asset, I have to pay two types of tax. I have to pay capital gains tax, assuming I've held it for more than a year. And then I also have to pay recapture tax. Now, your recapture tax is calculated on the amount of depreciation you've taken on the asset. So people will say, Eric, if I'm going to front load and take all this depreciation up front, don't I just have to pay that all back in 5 years when I sell it? And the answer is no, not necessarily. And I'll kind of walk through this example. The idea behind cost segregation is there's a rate arbitrage. So you're taking your deduction against your ordinary income, which, let's say I'm in the highest tax bracket of 37%, plus I live in California. And so that's another 13% state. So I'm getting taxed at roughly 50%. You take your deduction against that 50% combined state and federal. When you sell that asset, even if I had to pay it all back, right? I had to pay the whole amount back. I'm only paying it back at a capital gains rate or a recapture rate of maximum 25%. So you take your deduction against your income at 50, pay back at 25 and save the spread. So that's the first thing. Yeah, you do have to pay some of it back, but it's at a lower rate. That's the first thing. The second thing is you don't pay it all back. You pay a portion of it back depending on how long you own it. And I'll kind of back into this, Darren, because I think it makes more sense. But let me ask you this. If you buy a property for $1 million, sell it 5 years later for $2 million, when you go to settle up with the IRS and pay your taxes on that transaction, you're telling them that everything doubled in value, right? It went from $1 million to $2 million. That means your land doubled in value. That means your walls doubled in value. But you're also telling them your dirty old carpet that you've had for 5 years is now worth double what it was when you bought it. And that's just not the case. Carpet doesn't double in value over time. Carpet goes down in value. So by doing a cost seg study, you actually get to pull the carpet out of the transaction and say, I'm not selling my carpet for a gain. My carpet has a book value of 0. Carpet is a 5-year asset. In this example that I laid forward, that was a 5-year hold period. I bought it in 2020, sold it in 2025. I've owned it for 5 years. What's your carpet worth after 5 years? It's worth 0, right? It's a 5-year asset. You fully depreciated it. You don't pay any capital gain on that carpet. The gain goes to the building and the land. And so you're just reducing it. To summarize, I'll try to summarize without getting too far in the weeds, but take your deduction at a high rate, pay back a portion of it at a lower rate at a future date, and save the spread. And that portion is dependent upon how long you own it. The longer you own it, the less you pay back.
That was helpful there. The example there of talking about the life left in whatever it is that's still in the building there.
Right.
Because again, I've always heard about, okay, you've got depreciation, recapture, and capital gains. And I think there's 2 types of investors. I've always tended to be one that was thinking hold forever, or at least just grow and grow and grow the assets,
Right.
rather than cash out. I know a lot of times with if you're syndicating or working with others and stuff, it's not always as easy, and so this becomes more of a natural resolution as you're going to sell and pay the tax and move on to the next deal. But in the instance where you are able to roll out and roll into another property, is there any issues with the cost segregation study and doing a 1031 exchange? Does it create any issues?
No. So if you do a 1031 exchange, the nice thing is obviously you're deferring your taxes, but you're also deferring your recapture. So you're deferring your capital gain and your recapture. So you could do a cost segregation study, take your depreciation, do a 1031 exchange into a new property, and you're just kicking that can down the street and not having to pay any of that recapture or capital gains. And so they actually work very well hand in hand. The other thing is some investors, especially with this bonus period that we're in right now, even if you sell your asset, let's say I sell an asset in January and I sell it for, $1 million in gain. I sell it for $1 million and I'm going to have this big tax bill at the end of the year. Well, I'm going to go buy a new property and do a cost seg study and get a huge write-off, and that's going to offset my gain on that sale. And so even if you do want to cash out, if you have other investment properties or you plan on investing in other investment properties, you can do the cost seg from one building to offset the gain from another. And so that's another strategy that oftentimes we'll see utilized is just, if they don't do a 1031 exchange, maybe they do cost seg studies on some of their other holdings to create that massive deduction to offset the gain from the sale of an asset.
Yeah, I was realizing that, if you are rolling out of one and into another, and you've got the cost segregation study, option available to you, which obviously you would, just, with that much of depreciation, how much, it almost begs the question of why do the 1031? I guess you talk to your accountant and figure out, which one's better or whatever, but it
depends on strategies. Yeah, but you're right. It's a great opportunity to pull money out of that deal and have this massive deduction to offset it with. So you've got options, which is nice.
Got it. So who is this most ideal for? Is it strictly the big guys, or I mean, ordinary investors, or everybody?
That's a great question, because the answer is changed. And so we hear quite oftentimes people will talk to their CPAs, and their CPAs will say, hey, this only applies to those who are buying, large office buildings or large apartment complexes. And that was true prior to this bonus depreciation. Bonus depreciation has really opened cost segregation and depreciation up to all investors. And so we do single family homes where they bought it for 150,000, and the study might cost you 2,000, but you take $150,000 home, you get 30% of that. That's a $45,000 depreciation expense. Let's say you're in a 30% tax bracket. That's a $15,000 tax savings. And so, pay 2 to save 15. I'll do that all day long. And so we work with anything from single family rental homes up to, large office complexes, ski resorts, golf courses, et cetera. So it really has, like I said, this bonus depreciation. And I'll just add to that, bonus depreciation isn't going away at the end of the year. It's just simply being reduced down to 80% for 2023. In 2024, it drops to 60%. So it drops 20% every year after this year until 0 in 2027. So even next year and the following year, at 80%, 60%, those are still really good bonus years where you can buy assets, take your bonus depreciation, and pay very little taxes. So it's really opened the door for big investors, small investors, everybody really.
Right. And, we talked about new construction. We talked about, buying an existing building. Is there any issue if this is the first time you've heard of cost segregation, and you're, working with your accountant now, and you're going, I owe what? And, you say, well, wait, I heard about this cost segregation study. Does it work on something that you've had for a while? Or is there a number of years where obviously if you've had a building for 25 years, it's probably not a good thing. But if you've had a building for, 2 or 3 years, is it still an opportunity?
Yeah, absolutely. So there's something called a look back study, and we do those all the time, especially this time of the year. Because like you said, you go get your taxes done, and then your accountant says, well, you owe X amount in taxes. And you're like, wait, what? If you have existing properties, it's worth getting the numbers run, because the IRS actually allows you to go back and do a look back study and take all that missed depreciation that was available to you from 2017, 18, 19, 20, 21, when you owned the property in 2017. You get to take all that missed depreciation and drop it on your current tax return without having to amend any prior years. There is an additional form that needs to be filled out, and we actually provide that as part of our service. Most cost seg companies do. It's a 3115. I shouldn't say most of them do. A lot of them do. Some of them don't. But there's a 3115 tax form that basically says, hey, IRS, I bought this property in 17. I've been taking my standard straight line deduction for the last 4 years. It's now 2021, and I want to change my method to accelerated depreciation. And here's the difference in those numbers. And you get to take that large deduction on your 2021 taxes, again, without ever having to amend a prior year's return. So good news is for your listeners is, even if you filed your 2021 taxes, because those are due here in a few days, even if you file them or you've extended, you can still go back and do cost seg now. It doesn't have to be done in the 2021 calendar year. We really have until October 15th to finish cost segregation studies for the 2021 tax year. So it's a great opportunity. If you're paying taxes and you own real estate, you should definitely look into cost segregation, because the environment we're in right now is so favorable to real estate investors that you should be paying very little taxes if you own real estate and can absorb those deductions.
Yeah. Well, and I can give a testimonial. I haven't worked with you specifically, but just the whole nature of the cost segregation study. I did do one, and it was exactly that. My accountant said, well, you did this and that, and then you owe this much. I'm going like, what? I owe how much?
Right.
And And so we did a cost segregation study, and that little bit of investment, more than was, the benefits were far exceeding the cost.
Yeah.
And it totally eliminated the big tax bill that we were looking at. So definitely I'm a big fan of, and would encourage anybody who has not to check it out. And if you don't know any, I mean, get a hold of Erik. I mean, I got to say, you're one of the most clear spoken people I've talked with about cost segregation. So I think that's a great great opportunity for anyone. I was going to ask you, just with the compressing cap rates, and just the competitive market that we're in, do you see that cost segregation studies and like interest only financing are like really kind of some of the keys to really making these properties cash flow, or is that just more of like just the nature of just the market? Or
Well, we're all seeing those cap rates come down throughout the country. And I think that cost segregation can play a significant role in freeing up that cash flow. If you think about, again, let's just throw some numbers out, but if you let's just say you buy $1.2 million, an office building for $1.2 million, and let's say land is worth $200,000. So you have $1 million worth of depreciable basis. If you do a cost seg study and we create roughly on average, we typically segregate around 30%, like I said. So if we segregate 30% of that million or 300,000 into short-term assets, and you can write that off in the first year, 300,000, and let's say you're in a 30% tax bracket, that's 90,000. So that, on $1.2 million, what's the down payment on $1.2 million? I guess if you put down 10%,
200, or
probably
200,
20%, it's
25, 250.
You might get 90,000 of that back in the first year by doing a cost seg study. So you're getting half of your down payment back by simply doing now that's, again, assuming you can absorb those deductions and you have the income coming in from either that property or other properties. But it's a huge opportunity. It's essential right now, I think, for investors. And we work with a lot of syndicators who, they use this as a way to go out and drum up money to say, hey, give us some money to put down on this asset, and we're going to give you almost half of that, if not more than half of that, because we're going to leverage it, right? We're going to leverage this deal. We're going to give you a great portion of that back as a write-off in the first year. And so use it as a way to help drum up money or for yourself to lower tax bills. I think you're right on the head.
No, it definitely seems to be one of the kind of the lubricated, and it just makes the deal really work. Having the write-off there, and so that's good. If you had to kind of guess, is there a sweet spot for the type of property strategy that an investor may have that works best, or that you seem to work with most?
Sure. So, I mentioned, everything from small single-family rentals to large office buildings. On the smaller single-family rentals, you're not going to get as big a return. There's kind of a basement on what we have to charge for these studies. So, you might pay 2 and save 10 or 15. But we want to see at least a 7 to 10x return. And so anything over, $1 million, even 500,000, that's really where we start to see this just explode. You might pay us 4,000 for a study or 5,000 for a study on a larger building, but if you're saving 300,000 in taxes, I mean, what's the rate of return there, right? I can't do that math in my head, but it's huge. So, right. I would say that the ideal properties for cost seg are usually over 500,000. But even on those smaller ones, it's worth having the numbers run because there's still significant savings in some of those smaller assets.
No, agreed. Hey, Erik, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if we can avoid the risk. If that's not an option, then we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation and frame the question in a way that fits their situation.
Sure.
Could be your clients, your investors, tenants, the market, tax rates, however you want. But identify what you consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Erik Oliver, what is the biggest risk?
Yeah, for me, as I didn't have any investment properties when I started doing cost segregation. And so by working with clients all the time and seeing the value of owning real estate, I've started to get into real estate myself. And I think the biggest risk for me is I went back and forth. Do I need a property management group? Do I not? Do I manage these myself? I actually live by my investment properties. Don't step over what is the saying? Don't step over a dollar to save a penny. You know what I mean? Let the experts do it. There's a reason that they're property management experts. There's a reason that your CPA should be filing your taxes and you shouldn't be doing it yourself unless you know what you're doing. And so I think the biggest risk for me that I've had to learn is just that, let the experts do it. And I see it all the time in my industry where people do their own taxes on, I've seen people who make, in the millions of dollars and have very sophisticated tax returns, and they're doing their own taxes on TurboTax because they don't want to pay a wealth advisor or a CPA who has the experience. And I'm like, what you're going to pay that qualified CPA who understands real estate to do your taxes, you're going to get back tenfold in the amount of deductions and, the reduction in your tax liability. And so I think if I could just share one thing, and that is surround yourself. You can't be an expert in everything, right? And so know where your faults are and be humble enough to say, I'm not a tax expert or I'm not a property management expert. I'll tell you just a quick story. I learned it the hard way. My very first investment property was actually when I lived in Virginia. I moved out of Virginia and I moved to New York. And I said, I don't want to sell my house. I'm going to just rent it in Virginia and I'm going to do it myself. So I put an ad out there. I met with some potential tenants. I found some. They seemed like the nicest people in the world. I didn't know I should do a background check. I didn't know that I should run their credit. This is my first gig, right? So I'm like, oh, they're nice. They sat down. They talked to my kids. We had a great conversation. I rent the house to them. I moved to New York and I never hear from them again, right? They paid their rent the first 2 months. Great, on time, was perfect. But then the people that kicked them out of their old place started garnishing their paychecks. And that's when they stopped paying my rent. And had I done a background check, this all would have showed up, but I didn't want to pay the 10% management fee. I'm like, I want that for me. And so surround yourself with, I didn't know what I was doing. I thought I did, but I didn't. And I should have been humble enough to say, Erik, you don't know what you're doing. And so humble yourself and say, what are you good at? And you be the expert in that, but we can't be experts in anything, in everything. And so surround yourself with people who are good property managers, good lenders, good CPAs, good attorneys, good insurance agents, right? And let them be the experts and take their advice and be okay paying for that expertise because you're going to come out ahead in the long run.
Been there, done that. So baptism by fire. So,
right.
But no, I appreciate you sharing that. Erik, where can listeners go if they'd like to learn more or connect with you?
Absolutely. So you guys can go to our website. Our website is just www.costsegauthority.com. My contact information is on there. Feel free to use me as a resource. We don't bill by the hour. If you have a depreciation question, please call me, send me an email. We do free benefit analysis. So we'll look at your property before you ever engage us to do a study and say, hey, this is what the study would cost. This is what your potential tax savings would be. And then you can work with your CPA, or we can even get on the call with your CPA and say, hey, based on their whole tax situation, does cost segregation make sense this year? It's never a matter of should I or should I not do cost seg. It's just, is this the best year for me to do cost seg, or should I hold on to that and do that, play that card in a future year? And so again, we're kind of a niche accounting firm where this is all we do. We don't do tax returns. Don't reach out and ask me questions about child tax credits or earned business income, because I don't know the answers to those. But use this as a resource. If you have any depreciation questions, please use this as a resource.
Awesome. Erik, I can't say thanks enough for taking the time to talk. I've thoroughly enjoyed it and learned a lot, and look forward to doing it again.
All right. Sounds good. Well, thank you for your time. I really appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Networks, CRE PN Radio.